Real estate prices in Canada are on shaky ground, and that's got a lot of people wondering how low real estate prices may go. My name is Sergey Modilevsky. I'm a mortgage broker, and I like to talk all things personal finance. I like to share my thoughts and experiences with you guys in hopes that it might help you manage your own finances with more confidence. If you like this sort of content, if you could hit the thumbs up and subscribe, which would really help me reach a lot more people and grow on YouTube. Here's some background. Since recovering from the great financial crisis of 2008, home prices have increased stably. Things changed in 2020 when coronavirus forced lockdowns and people began to work from home and remotely. Housing market during COVID, people began to place more value on their homes or surroundings because they spent much more time in them. Then, banks and the government responded to lockdowns by flooding consumers and businesses with low rates and stimulus. Everybody wants to own real estate in that environment, creating excessive demand for buying a home. At the same time, home builders weren't able to keep up with that demand because of those very same lockdowns. That increased prices in every market and every type of housing segment. It created a lopsided seller's market, resulting in bidding wars and unconditional offers. As recently as July 2020, Bank of Canada Governor Tiff Macklem assured Canadians that rates are very low and they're going to stay there for a long time. Driven by that belief, people were comfortable paying $100,000 over asking because the borrowing cost was under $2,000 a year. Borrowing costs and expenses were so low that some people could rent out their existing home and purchase a new one, further constraining the supply of homes. Over 2 years, many areas increased in value by 50 to 100%, the highest appreciation on record. The Bank of Canada poured gasoline on the fire in June 2021. Deputy Governor Tim Lane stated the bank's belief that inflation would prove transitory and would not persist beyond the next few months. After that, home prices continued to accelerate, and so did just about everything else in the economy. Eventually, in November 2021, they had a mea culpa and admitted that inflation would be around a lot longer than they expected. By the start of 2022, the Bank of Canada admitted that inflation was too high and became a top priority. There are two fundamental steps to breaking inflation: increasing supply and curbing demand. The central bank's focus is on cooling demand, including real estate. In societies strapped with debt, you cool demand by raising borrowing costs on everything from mortgages and car loans to credit cards and buy now, pay later programs. Mortgage rates began to climb in January, but in February 2022, the forecast for interest rates took off. The war in Ukraine has been tragic, and it's fractured this foundation of globalization that had been built over 30 years. 1 month after the war in Ukraine began, authorities in Shanghai announced that they'd be locking down 26 million people to fight the latest outbreak of coronavirus. These events have created massive supply chain disruption across most sectors and created enormous inflation in commodity prices. Critical commodities like oil, natural gas, corn, and wheat affect the prices of almost all goods and services, so short-term inflation expectations spiked. The Bank of Canada responded by raising overnight rates by 25 basis points in March, 50 basis points in April, and 50 basis points in June. Economists believe that the Bank of Canada will raise another 50 basis points on the July 13th meeting in order to fight historically high inflation. The best case scenario to curb inflation is through a soft landing, where the Bank of Canada raises interest rates enough to curb consumer demand without crashing the economy and breaking something. Since interest rates began climbing, lenders have seen a massive decline in mortgage pre-approvals. MLS listings across the Greater Toronto Area are seeing more terminations, price amendments, and fewer showings. Since home prices peaked in February, many regions have seen a significant decline in home prices. This dramatic shift in market sentiment actually took place before two really important additional price pressures set in. The first are the two 50 basis point hikes from the Bank of Canada in June and July. And the second is that all the mortgage pre-approvals that people previously had that would have been in the high 2% or the mid 3% are now expired. When making this video, someone taking a new 5-year fixed mortgage will see rates nearing 5% and will see a qualifying rate nearing 7%. As a result, new buyers have a lot less borrowing capacity than somebody who is buying at the start of the year. This change in borrowing costs has reduced demand among first-time buyers because they have less borrowing capacity and in some cases can no longer afford to buy at all. Fewer investors want to buy because of a higher borrowing cost and a lower cash flow. More builders may be delaying or canceling projects as a result of labor shortages, higher borrowing costs, and higher material costs. Over the next 6 to 12 months, there's going to be a lot more pressure on existing homeowners with maturing mortgages or adjustable rate mortgages. As their payments increase, we're likely to see a significantly larger amount of inventory come onto the market over that period. Because of rising interest rates, we see people selling off assets very quickly in this market. Stocks, bonds, and cryptocurrencies have fallen swiftly. Economists refer to this as the destruction of the wealth effect. When your investment portfolio increases in value, you're more likely to bid aggressively on real estate. But once prices begin to decline, people tend to become a lot more conservative. The destruction of consumer demand can take a long time, as portfolio values decrease and the cost of borrowing and the cost of goods rises. Wealth effect destruction is impactful on everyone, from corporations who are seeing their stock value erode to mom and pop investors who are seeing their RSPs and TFSAs decline in value. Typically, when asset values decline, consumer demand also decreases, which may help reduce inflation over time. Here's what I believe will happen with real estate prices. Different regional markets will experience different price dynamics until there's a rebound in demand. In many regions with lower median incomes, real estate prices may fall but will not crash in the months ahead. Many areas have already seen double-digit price corrections since peak home prices in February. If they fell another 10%, new home buyers would see similar borrowing costs to 2021 despite higher borrowing costs. Prices may fall further in these areas as the economy absorbs interest rate hikes from the Bank of Canada and all-time high inflation readings in the months to come. A few factors will keep housing prices from crashing substantially. This year, Canada will have record high immigration while building an insufficient supply of housing. Also, many homeowners who secured a mortgage over the last 2 years are not going to be inclined to sell their home and give up those historically low borrowing rates. Mortgage borrowers in Canada have been stress tested since 2017, so we know that they can afford the higher payments that they're facing today. I believe that you should view the purchase of a primary residence for your family as more than an investment. Today's market environment will give you more inventory to choose from, a less competitive environment in which to place offers, and allow you to set conditions to ensure that you're making a diligent purchase. That's an ideal environment to shop for real estate. If you'd like to get pre-approved for a mortgage or discuss a refinance, I encourage you to get in touch with me. I've left my contact details in the description below. Thanks for tuning in, and I'll see you in the next video.